This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 5 videos on trading broad bull channels. I want to begin by making the point that traders can swing trade and use wide stops when they're buying with the trend. Also, just like with trading ranges, you can get second leg traps within broad bull channels where you start to have a rally, a pullback, and then you have an even stronger second leg up, but it fails and leads to a reversal. Because a broad bull channel has a lot of trading range behavior, bears will sell new highs and above new highs. Some bears will use wide stops and scale in. This is a 5-minute chart of the euro versus the dollar. Some traders do not like to buy and exit, buy and exit, buy and exit. They prefer just to buy and stay long until the market clearly becomes always in short. For example, we have a very strong reversal up here. We had a bull breakout, and this is a deep pullback. It fell below the breakout, but it did not fall below the bottom of the bull trend. And this is a clear, strong resumption of the bull trend. A 2-bar pullback. Some bulls would buy with a stop above the high of that bear bar, or maybe above here for a second entry buy. As long as the market stays above this low, they're going to conclude that the market is going to work higher. Even if there is a series of strong bear bars like this, as long as the sell-off stays above the bottom of the bull trend, they're going to assume that the market will work higher. When they bought, they were confident of one thing, that the market was not in a bear trend. There were a lot of bear bars here, and then here, and here. However, once there was this strong reversal up after this attempt down, and it's a second reversal up, the bulls were confident the market was not in a bear trend. That means it was either going to be in a bull trend or in a trading range. In either case, if they buy here, they should be able to make money. Either the market will go up and they can make money, or it will go down but stay above this low and they could buy more and make money. This sell-off was probably a sell vacuum test of support. It was a test of this higher low and a test of the high of this bull bar. And the bulls were hoping for a double bottom bull flag with this low and with this low. And that's what they got. The market reversed up there. A lot of traders will see the market as still always in long. We have 5 consecutive bear bars, but they're not very big. Some have tails. And the sell-off is not nearly as strong as the rally here or the rally here. Finally, it's still above the bottom of the bull trend. And therefore, even though it might be always in short, expecting a little bit lower, some traders will say it's fundamentally always in long. The big picture is it's always in long, and the market is either going to go sideways or up. And therefore, these bulls, instead of getting out up here or even here, they'll rely on their stop and bet that the market is either in a trading range, in which case they should be able to avoid a loss, it'll go sideways, or it's in a bull trend. At this point, we have a wedge top, 3 or 4 pushes up, 1, 2, 3, or 4. We have a high 2 bull flag late in the bull trend, and we have a pair of bear bars, and we're getting late in the session. A lot of bulls would get out at that point, or they would wait for a couple consecutive decent-sized bear bars and then get out at the close of this bar. Is the market always in short? Well, it might be, but it's so late in the session, the market usually enters a tight trading range. Therefore, at this point, it's not worth shorting, especially once you start to see a series of small bars like this. Whenever the market's in a bull trend, bulls like to trail their stops below the most recent major higher low. And by a major higher low, I mean a higher low that leads to a strong reversal up and usually to a new high in the bull trend. Then this low becomes a major higher low. At this point, I think this is a major higher low, even though the strong reversal up did not yet go to a new high. Because if the market fell below this low, traders would change how they view the market. At this point, they think it's either a bull trend or a trading range. If it gets below that low, they'll think it's either a trading range or a bear trend. Reasonably strong breakout to a new high. Therefore, this low is major. As long as it stays above this low, it's either in a bull trend or a trading range. Therefore, bulls would put their stop below that low. Another strong breakout to a new high. Is this a major high or low? Most traders would call it major high or low. Other traders would say this is still major. However, if it fell below the bull breakout, but not below the bull trend, and then reversed up, the bulls who get out using a stop here will buy again on the reversal up. This is a reasonable stop, as is this. As long as a trader uses a reasonable stop and manages his trade correctly, he's going to do well, and it does not matter which of the two stops you use. If you use this stop, your stop would not have been hit. If you use this stop, it would have been hit, but you would have bought on the reversal up or over here or over here. Strong reversal up, even though it did not make a new high, the context is really good. The bears have a breakout below the bottom of the buy climax, but they could not get below the bottom of the bull trend, and the bulls bought aggressively. Therefore, this low is major. Another strong breakout to a new high. Is this a major high or low? It's similar to this, a bull breakout, but not the bottom of the bull trend, a bull breakout, but not the bottom of the bull trend. A lot of bulls prefer to use the wider stop, just in case the market has a deep pullback, yet it still is in a broad bull channel. Another strong breakout to a new high. Is this the major high or low, or is this the major high or low? To me, I think this is the major one, but it's again similar to this. You have a bull breakout, and lower down, you have the beginning of the bull leg. You have a bull breakout, lower down, the beginning of the bull leg. A bull breakout, lower down, the beginning of the bull leg. And you could use either one. They're both reasonable. When the market's in a broad bull channel, most traders are not going to let their stop get hit. They're going to exit or go short on a reversal down after a new high. No matter where they buy, some bulls will simply trail their stop up, whether they buy here or bought here. After each new strong breakout to a new high, they'll trail their stop to below the most recent major high or low. But they're not going to let their stop get hit, especially late in the session. If there's any significant reason to think that the market might reverse, here, as I said, there's a wedge top, they'll simply get out before their stop gets hit. I said that some bulls would put their stop right below the bottom of this bull breakout. Other bulls would not. They would rely on a stop below the bottom of the bull trend and buy more below this breakout, betting that the bear breakout would fail and lead to a reversal up. We have a small wedge at the bottom here and then a pretty good reversal up. So by the close of this bar, the market's always in long. That means the odds are it'll go at least a little bit higher before it goes below the bottom of that bull reversal. When a trader is long for any reason, anywhere in here, and then he sees a very deep pullback like this, he's going to conclude that the market's either in a broad bull channel, a weak bull trend, or in a trading range, in which case they want to buy low and sell high to take profits. As long as it's forming major higher lows, it's either in a trading range or in a broad bull channel, and therefore it's not in a bear trend. Some traders prefer only to take buy signals, and they can get out at new highs or above prior highs, and they'll look to buy deep pullbacks somewhere in the middle third of the most recent leg up. So bull leg up, somewhere in this middle third, bulls will look to buy again. Buy on a reversal up, little bull flag, they can buy. High two buy, they can buy. Because you don't know if this is going to remain a bull channel and get higher highs and lows, or if it's evolving into a trading range, big up, big down, big confusion, and might simply stay sideways. A lot of the bulls will scalp out as long as they take a profit that is at least twice their actual risk, and as long as the profit is at least as big as a minimum scalp. In the Forex markets, a minimum scalp is 10 pips. If you're entering a trade, never try to go for a profit less than 10 pips. Let's say you bought above the high of this bull bar and you see the market go up like that. Your actual risk is just to 1 pip below that bar. You know that once the market is up here, that as long as you had a stop 1 pip below the low of this bar, you would not have been stopped out. If you bought above this bar, and had you known and had your stop 4 pips lower, you would not have been stopped out. And therefore, your actual risk was only 4 pips, and 2 times actual risk is only 8 pips. However, it's not at least 10 pips. Remember, a minimum scalp is 10 pips, and therefore, even though exiting right here is twice your actual risk, it's not also bigger than your minimum scalp. Therefore, you should not exit here. You always want to be exiting with a profit that is at least 1 or 2 times the size of the minimum scalp size. And in the Forex market, that's 10 pips. Here, the market went up more than 10 pips, and therefore a trader who bought here could exit here, taking a chance that the market's just going to go sideways, and he just wants to scalp within a small trading range. Other traders who buy here will sell on a reversal down. They hold just in case we get a big breakout, but if we get 2 legs down, especially at the top of the trading range, they'll get out on the second entry, first entry, second entry. So that's reasonable to exit there as well, even if it turns out to be less than 10 pips. The market rallied enough for them to get out with 10 pips here. If they did not get out here and they held, and they conclude the rally looks like a bull leg and a small trading range, they'll switch to scalping and they'll get out on the reversal down. If you did not exit here and you were taking a chance that we're going to work higher, another place where you might exit is at this prior high, betting that we have a double top. And we have a fairly weak rally. We have 2 bull bars here, and then terrible follow through for the bulls here. They're disappointed, and now they're thinking this might be a trading range, and therefore they might try to sell out of their long at the prior high. Let's say you took any of these buys. We're testing the high close. The bulls who bought that close are disappointed by this follow through. They were not able to get out, break even at this bar. Some of them will buy more here on a reversal up. These bulls who bought here will be very happy to get out around their original buy. If they bought that close, when it gets back to that close, a lot of the bulls will sell, trying to get out, break even here. And if they add it on here, they'll get out with a profit on this lower entry and break even on the first entry, or around break even on the first entry. If it got to that high close, did not get above it, your limit order to sell at the high close did not get filled, you might get out on a reversal down below a little bear bar. Late in the session, possible final flag, a pair of bear bars, one closing on its low. A lot of traders will give up and exit here at the end of the session. I talked about second leg traps. They're common in trading ranges. Broad channels have a lot of trading range price action, and they also have a lot of second leg traps. Second leg trap is a breakout that makes traders believe the market might be turning into a strong trend. It traps traders into buying the breakout, like buying that close, and then it reverses down. It traps them into buying high. Strong leg up. And now we have a second leg up. The bulls are hoping it's the start of a bull trend, but instead it traps the bulls who keep buying all the way up. Now they find that they bought at the high and the market reverses down. Once the trader sees a breakout, if he's a bull, a lot of traders will start to buy closes. Example, another pair of bull bars, this one closing on its high, they'll buy that close, they'll buy that close, hoping that this is going to result in a very strong bull breakout and then maybe a channel up. Disappointing follow through here and here is telling the traders that, well, it's maybe not going to be a strong bull trend. Maybe it will be a weak bull trend, which means a trend that has deep pullbacks, a broad bull channel. The disappointed bulls get trapped into a bad position. Many of them, after they see this disappointing follow-through, will try to get out break even, conclude that it's a broad bull channel and that it will have a deep pullback, and then they look to buy again lower. Same here. If they bought here, they're disappointed by a micro double top and a bear bar. A lot of them will place a limit order to get out break even, and you can see this bar hit this close but did not get above it. The bulls who decided to get out break even were unable to get out, and they'll get out on a reversal down. This bear breakout, consecutive bear bars, represents the final bulls giving up, and aggressive bears selling, hoping that it's the start of a bear trend, a reversal, bull trend, bear trend. 5-minute chart, euro, several sessions. Second leg trap. We have 2 legs down here in this particular case. Very often the second leg down is strong enough in a broad bull channel to convince traders that the market is always in short and it will probably go lower. When you see a strong leg down, in general, 60% chance there's going to be at least a small second leg down, except if you're in a trading range or if you're in a broad bull channel. And then the odds are you're not going to get a lot of follow-through selling. At this instant, down here at the low, there's only a 40% chance of a strong reversal up. However, once you see the reversal up, you know the market is back to always in long, and instead of the start of a bear trend, a second leg down, it becomes a large 2-legged bull flag, leg 1, pullback, leg 2. At this point, you know that this is more likely a large bull flag than the start of a bear trend. Once it reverses up sharply like that, traders assume that this is simply a pullback in a broad bull channel, and they'll look for a measured move up. At this point, the bears are hoping for a double top, break below the neckline, and measured move down. The bulls are hoping for a double top, a break above, and a measured move up. Therefore, traders look for a measured move up based upon the height of the breakout. And you can see what happened when it got to that measured move. It sold off sharply. So a lot of the bulls who bought after seeing this breakout took profits at a measured move up based upon the height of this bull reversal. When you're trading, you're always going to be paying attention to how far a breakout goes above a prior high. For example, how far did this high go above that high? How far did this high go above that high? We have a rally and a reversal down. If the market gets above this high, this becomes a breakout point. This is the top of the breakout. Traders want to pay attention to how far the top of the breakout is above the breakout point. In this case, the top of the breakout is 24 pips before we get a pullback. Traders will pay attention to that, and anytime the market goes 24 pips above a prior high, traders will expect another reversal. And they do it all the way up. This high is 13 pips above this breakout. This high is 9 pips above that breakout. And you can see that the breakouts seem to go about 9 pips above, and the biggest one is like 19 or 20 pips above. And that means every time the market goes about 10 or 15 pips above a prior high, bulls will look to exit, take profits, and bears will look to begin to sell. Because a broad bull channel has deep pullbacks, bears can make money by selling. I always pay attention to any bull trend to see if it's forming gaps. If the market is forming a lot of gaps, it's a stronger trend and it's likely to go a lot further, and bears do not want to sell, because if they're selling above a prior high and the pullback does not fall back below that high and then the bull trend resumes, the bear who sold at that high and scaled in higher will not make money. We have a reversal down, so this is a breakout point. We broke above it, so this is the breakout. And then after this little pullback, it never came back below this high again. The bears who sold maybe 10 pips above, 20 pips above, some of them scaled in higher. If they did not get out immediately, let's say they sold this high and 10 or 20 pips higher, they could have made a profit initially. But let's say they're trying to go for bigger profit. So they sell this high and maybe 20, 30, or 40 pips higher. And then they get this reversal down. It does not fill them. They're trying to get out break even at this high, and this never fell below that line. And then again, the bears, maybe they sold more at a new high, maybe a reversal down. Again, got near their breakout point where they originally went short over here, but never fell below it. The result was a double bottom bull flag. The bulls bought the reversal up, betting that the trapped bears would have to buy back their shorts. And it usually results in some kind of a measured move. This is the beginning of the bull breakout, and this is the top that reversed down. The market tried to get below it a second time, and started to go up again. That tells you that the market is paying a lot of attention to this price. It's an important price. This is a major higher low, so it's an important price. When you have two important prices, they usually lead to a third important price, a measured move. When pullbacks fall below breakout points, like this breakout falling below this point, it's a stairs pattern. Breakout, it fell below the breakout point, and bears can make money selling. Traders use the size of prior breakouts to manage their trades, decide where to take profits if they're long, decide where to get short. Stairs, we have a breakout, but then we have a pullback below the breakout point. Bears can make money selling. Whenever the market's in a trend, I'm constantly drawing lines. Bulls and bears draw lines all the time, whether it's in a bull trend, a bear trend, or a trading range. I have a reversal down and a second reversal down, I'm going to draw a line. I have a reversal down, another reversal down, I'll draw a line. Reversal down, second reversal down, I'll draw a line, and I want to see how the market behaves when it gets to that line. We have a rally and a reversal up, I'm going to draw a line. If the market comes back to that line, I want to see if bulls will buy. And if it looks like bulls are buying, and if it looks like we're not getting a strong breakout below the line, I want to buy as well. Same thing here. Reversal up, I draw a line. It fell below the line but reversed up, that's a buy. Whenever the market's in a channel, you draw lines across the top, the channel lines, and you draw lines across the bottoms, trend lines, and there's a 75% chance that a breakout above the top or below the bottom will fail and reverse. And therefore, if the market's at the top of a channel, the top of a line, and it starts to reverse down, traders will sell. Some traders will sell with limit orders at the line. Opposite is true at the bottom of the channel, at the bull trend line. Traders will either buy with limit orders just above the line or at the line, or on a reversal up. Some bears simply sell with a limit order at the prior high. So they see a reversal down, they'll place a limit order to sell at that high, their order gets filled right here. Some of them will use a wide stop and scale in higher. These bears are expecting a trading range and they're looking for a scalp out. Traders who are selling in a bull trend need to come up with some logical location for their stop. If you're selling with a limit order here, where's your stop? One way to determine a stop is put it just beyond some kind of a measured move. We have a double top. Instead of breaking below the neckline, we broke above, and therefore this is a measured move. Some traders will put their stop just above that measured move target. If a trader sold here at that high, the market rallied 20 pips or so and then reversed down. That trader had 21 pips risk. This high is 20 pips above their entry price, and therefore their actual risk is 1 pip more, or 21 pips. The bears are selling in a bull trend or in a trading range, and therefore they're going to scalp. And they want to take a profit that's at least as big as the minimum scalp, which is 10 pips. And they prefer to take profit that is at least 1 to 2 times their actual risk. Here, their actual risk is 21 pips. 1 times actual risk is here. They entered right here, and the height of this pink box is their actual risk, and a measured move down is here, so they can take profits in that general area. We have a deep sell-off, so a lot of bears will place a limit order to sell at that high, betting it will not get much higher, and it will fall far enough for them to make a profit. They might again use some kind of a measured move up for their stop, put the stop just above the measured move. Same thing here. They sell with a limit order at a prior high. They look for some kind of a measured move. We have a double top neckline. So instead of looking for a measured move down, they know it's probably just going to be a scalp. They'll put their stop just beyond a measured move up. Same thing here. They sell at the prior high, use a stop that's maybe just beyond a measured move up, and look for a scalp down. If a bear sells, he can take profits using many different approaches. One is simply a fixed number of pips. For example, he might take profits 20 pips down with a limit order and get filled right here. Or he might want to take profits at a support level, like a prior low. If he sells here, he could place a limit order to buy at that low. Or he might buy back his shorts on a reversal back up. So for example, if he sold at this high and the market gets a double bottom, he may buy on a stop on the reversal back up. Let's say a bear sold at a prior high. He gets filled right here. If a breakout becomes too big, the bears have to get out. They don't want to be holding a short in a bull trend when the bull trend is very strong. Again, you might put your stop at 2 times the size of the biggest prior breakout. Here we have a breakout that went 24 pips and then reversed down, had one more little high before a deeper reversal down. So a bear selling at this high might put his stop at twice the size of this, or 1.5 times the size of that. The biggest prior breakout was 24 pips, and he might put his stop at twice that, or a little bit more than twice that, so at 49 pips up. A bear might sell at a prior high. Minimum scalp size is 10 pips. His minimum reward has to be at least 1 to 2 times actual risk. Once the market started to turn down, he knew that his actual risk was just 1 pip above the high of this reversal. And that reversal up is 4 pips, and therefore his actual risk was 5 pips. 2 times his actual risk is 10 pips, which is the size of a minimum scalp, and therefore it's reasonable for him to exit there. Look at the size of the pullbacks. The channel has been about 70 pips tall, 50 pips, 70 pips or more. Some traders who take that sell are going to assume that the pullback from the top to the bottom of the pullback is going to be 50, 60, 70 pips, and therefore 20 pips or 10 pips might be too small. He might try for a bigger reward, like 20 pips or even 50 pips. Or he could simply hold for a swing down, and once the swing reaches 30, 40, 50 pips, he can buy back his shorts, take his profits on a reversal up. We have a strong reversal down, so a double top, and then we get a strong reversal up. Whenever you get a strong reversal up after a strong reversal down, there's a surprise. And usually that means that traders are trapped into thinking the market's going down, and now it's going up strongly. Whenever there's a surprise like this, the market usually has a second leg up. And when they see this reversing up strongly like this after reversing down strongly like that, most traders are not going to sell at this high because they're going to expect a second leg up from this reversal and maybe a measured move up. This was a possible wedge top, and now we're getting a possible breakout above a wedge top. The bulls have a reasonable chance, better than 50-50 chance of at least some kind of second leg up, and maybe a 40-50% chance of a measured move up. If a bear sold at this high, the market never came back far enough for him to make a profit. And if he held on to his shorts, he eventually would have been stopped out. Let's say he used a measured move up from this low to that high for his stop. He would have been stopped out. Some bears use wide stops and scale in. Let's say we take this same bear who sold at this high and used a very wide stop and was willing to scale in higher. He sees all of these deep reversals. He knows that a broad bull channel sometimes has a breakout and a gap that stays open. However, he's confident that the market will continue to have fairly deep swings down. So if he scales in higher, uses a wide stop, he can avoid a loss and maybe make a profit. So let's say he used a wider stop, maybe based upon a measured move up, using this low, which is a major higher low, and this high, which is a major reversal down. This would be the measured move up. He might put a stop just above that. He sells here, and the market never got down to his entry price, and therefore he could never exit break even. It tried to get down here, tried to get down there, both times reversed up. Now we have a double bottom in a bull trend, so a double bottom bull flag. And here we have 3 reversals up, 1, 2, 3. So a possible wedge bull flag, a bear breakout below the wedge bull flag that's reversing up. This bear, if he sees this, he's got to get out at some point. It did not hit his stop, but we have a wedge bull flag and a double bottom bull flag, and twice the market tests the breakout point and does not close the gap. The bears have to conclude that they're wrong and they have to get out and take the loss. Other bears, instead of selling here, hoping the market goes down for a profit, they'll sell here and sell more higher just in case there's a gap that stays open. They want to be able to avoid a loss or maybe at least make a small profit. Whenever you're adding on to your position, you're increasing your risk. If you take this short and you're thinking about adding on higher, you have to trade a smaller position because if you add on, you're going to have a double position. Why are you adding on? You're adding on to increase the probability that you'll either make money or avoid a loss. Whenever you get better probability of making money, you pay for it with worse risk reward. Either the reward is less or the risk is greater, or both. Let's say you're a bear and you sold at this high, you get filled here, and you decide to sell more at fixed intervals, like 10 pips higher, or maybe 30 pips higher, or maybe 50 pips higher. Or maybe you want to sell here and then you know where your stop is. Maybe you want to sell more halfway up to your stop, 50% of the way up. That's another way to scale in. Or the market's making new highs. Maybe you'll sell more at a prior high. Again, relying on your stop. Another way to do it, and a better way to do it for most traders, is if you're thinking about scaling in, after your initial entry, you look to sell on a reversal down, especially if there's a good signal bar, which you cannot see because this is a bar chart and not a candlestick chart. If a trader took any of these second entries, here's their first, if they took any of these second entries and they get out on this reversal up, which they'd have to because it's a double bottom bull flag, the gap is staying open, it's twice testing the breakout point, reversing up both times, you have to get out. But had you taken any of these entries, either you would have reduced your loss or you possibly would have ended up with maybe a small profit. This is a thumbnail of that last slide. This blue box is this entire screen. So this is zooming in on this little blue box right here. There's that blue line. Here's the blue line. I said you went short over here at that breakout, and that's right there. If you scaled in, like a second entry short below a bear bar here, or below a little small final flag below this reversal bar here, there's your first entry, there's your second or second entry. Remember, your stop is up here beyond this measured move target. You could exit down here on a reversal up and avoid a loss and probably make a small profit. Your first short is right here. If you sell more here or here, and you get out here or here, you'd get a small loss here and a bigger profit here or here. I would not get out here because this channel is too tight. We're probably going to get at least a small second leg down. But here we have a micro double bottom, a wedge bull flag, one push up, second push up, and now a third push up with two pushes up, micro double bottom above your original entry price. If you were trying to get out with a limit order at that original entry price, at this point, I think you have to get out. You take the loss on this trade. So you sold at this price, you'd get out here for a small loss, and you sold more here or here, you'd get out with a bigger win. We have a breakout here and then a breakout here. Traders pay attention to how big the breakout is before there's a pullback, how big the breakout is before there's a pullback. 24 pips, 13 pips. Some traders, instead of selling at the prior high, will sell 13 pips above the prior high. They'll look at this and say that, well, this breakout will probably be similar to these two before it pulls back. Instead of selling at this high and getting filled here, they might sell 13 pips above or 24 pips above, like here, or some number in between. Again, if you're scaling in to a bull trend, a broad bull channel, you need a wide stop, and a measured move up is reasonable. A double top, measured move up from the double top. That's a reasonable location for your stop, just above that measured move. Well, let's say you see this breakout is 13 pips above this high. Then you sell 13 pips above this high. You might sell more 13 pips higher. So your first entry is 13 pips above this high. You get filled here. you might add on 13 pips higher, scaling in. You might even add on again 13 pips higher. At some point, you'd conclude the size of the rally was very disappointing if you're a bear, and you might decide to get out break even on your entire position. Your average entry price is exactly at your second price, and therefore, when the market gets down there, you exit and you are scaling in, not to make a profit, but to avoid a loss, which is okay. Some traders do that. Or you could try to get out break even at your original entry, in which case you'd make 13 pips on your second entry and 26 pips on your third entry, and you'd get out break even on your first. Bulls also look at the size of breakouts, and they use those numbers to take profits. For example, we know this breakout was 24 pips up, this one was 13 pips up before the market reversed. Let's say you bought here. We have a triple bottom or a wedge bear flag, and we're getting a bull breakout. Let's say you bought here. You can call it a triangle if you want. You could exit exactly at the prior high, or you could exit based upon the size of prior breakouts. For example, you might get out 13 pips above this high, just like this reversed down 13 pips there, or you might get out 24 pips above the high and get out here, because this breakout was 24 pips above that breakout. And you can place your limit order a pip or two below the size of the prior breakout. I began by talking about swing trading using wide stops when the market's in a broad bull channel. Like in a trading range, broad bull channels often have second leg traps, trapping traders into thinking there's going to be a strong breakout leading to a bull trend, a stronger bull trend, but instead it reverses down. Because a broad bull channel is basically a trading range that's sloped upwards, bears can make money selling. Some bears sell with limit orders at prior highs, and they use wide stops and scale in. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trading broad bull channels.